Hey everyone, and welcome to today's Explainer. Today, we're unpacking a massive, often incredibly frustrating mystery in business finance: payment processing rejections and frozen accounts. I mean, it happens to completely legitimate businesses all the time, right? So we're going to figure out the mechanics behind exactly why this happens so you can finally take back your operational power. Okay, let's dive into this. Is your business secretly high risk? Honestly, it's a terrifying thought. You're out there, grinding, running your company, making sales, and then suddenly, bam, your payment processor freezes your account or hits you with a massive rejection letter. No warning. You might be selling travel packages, coaching services, or health supplements completely legally. Yet traditional banks are treating you like this huge liability. We need to figure out exactly why this happens, and more importantly, how we can fix it together. Now, the absolute most important thing to internalize right off the bat is this: a high-risk label is not a moral judgment on your company. If you get flagged, it's really not personal. To the underwriters, it's strictly a calculation. It's math, compliance, and risk exposure. That's it. It's just an equation, and once we know the formula, we can absolutely solve it. So here is our roadmap for today. 1. The high-risk misconception. 2. Industries versus behaviors. 3. Red flags and risk signals. 4. What changes for you? 5. The approval readiness checklist. And finally, 6. Finding a reliable partner. Let's get into it. Section 1. The high-risk misconception. What exactly is high risk?
When you strip it all down, high risk simply means there's a higher financial or reputational risk to the bank itself. These potential losses usually stem from compliance headaches, costly dispute management, or potential fraud. Traditional banks are notoriously cautious. Honestly, sometimes bordering on paranoid. If they sense a high potential for chargebacks, or if your industry faces heavy regulatory scrutiny, they get incredibly nervous. They just lock things down to protect their bottom line.
Section 2. Industries versus behaviors. Who you are versus your actions. And this brilliantly illustrates a vital concept. There is a massive difference between inherent industry risk and your actual behavior. High-risk industries like CBD, travel, or firearms have inherent exposure just by existing in those sectors. You really can't change that. But high-risk behaviors? Things like high dispute rates, misleading trial offers, or super slow fulfillment? Those are completely actionable. You can actively change your behavior to improve your risk profile, literally no matter what industry you're in. Section 3. Red flags and risk signals. What underwriters are actually looking for. You kind of have to think of underwriters as financial detectives, and they are hunting for specific triggers. High chargebacks and disputes, that screams to them that a business can't successfully fulfill orders. Frequent refunds suggest maybe some deceptive practices or unhappy customers. Delayed fulfillment without proof of delivery or tracking is a massive trigger, especially for custom orders. If a company sells regulated products but lacks clear catalog definitions, huge red flag. And finally, excessive cross-border sales trigger alarms because capturing funds is way harder and fraud is just statistically higher in certain regions. But the beautiful thing here is improving stuff like your shipping tracking or having crystal clear refund policies directly reduces these behavioral signals. But if these risk signals go unchecked, the consequences are severe. A payment processor could hold your hard-earned funds in a rolling reserve for 90 to 180 days. They do this to protect themselves in case of default, sure. But just imagine trying to run a business without access to your own cash flow for up to 6 months. It's devastating. Section 4. What changes for you? The actual operational reality. The operational differences between a standard and high-risk account are pretty stark. With a standard account, underwriting is basic, often just a quick credit score and processing history check. But a high-risk account triggers deep underwriting. We're talking diving into business docs, thorough website reviews, the whole shebang. Standard accounts have minimal reserves, while high-risk accounts face those massive 90 to 180-day holds we just talked about. Pricing shifts from standard flat fees to risk-based tiers, which are usually higher. Monitoring changes from passive to aggressive ongoing reviews. And your payout timelines, they can vary wildly based on perceived risk rather than arriving in a standard couple of business days. Section 5. The approval readiness checklist. Your checklist for success. You might want to take a mental screenshot of this because you actually have the agency to pass the underwriter's test before you even apply by optimizing your operations. First, have your EIN and articles of incorporation ready to go. Second, gather a solid banking and processing history. Third, and this is a real game changer, ensure your website's refund, shipping, and cancellation policies are crystal clear and super easy to find. Fourth, document your exact inventory and fulfillment workflow. Fifth, establish strict risk controls, meaning you have a real plan for fraud screening and dispute handling. And sixth, verify your regulatory needs, like having certificates of analysis ready for CBD products. Section 6. Finding a reliable partner, because you really don't have to go it alone. So the crucial point is this. If you've optimized your behaviors and prepared your checklist, but traditional banks still say no, there are specialized partners built specifically for this. Adaptiv Payments, for example, offers reliable, high-risk merchant accounts because they inherently understand the complex, unique challenges of these niches. They aren't scared of your industry. They are literally built specifically to support it. Instead of punishing businesses with arbitrary fees, Adaptiv provides competitive risk-based rates. Remember those chargeback red flags we discussed earlier? They offer advanced chargeback management and integrated fraud protection right out of the box. They have tailored solutions whether you are in travel, health supplements, or e-commerce, and they seamlessly integrate with platforms like Shopify and WooCommerce. They essentially turn what is normally a stressful adversarial underwriting process into a streamlined partnership. I want to leave you with a final provocative thought. Your industry might be high risk, but is your payment processor up to the challenge? If you're constantly battling account freezes, withheld funds, or just terrible customer service from your current provider, it might be time to reconsider your financial partnerships. Understanding your risk profile is the first step, for sure, but aligning with a processor built to actually support you, that is the ultimate solution. Thank you so much for joining me for this explainer. Keep learning, keep optimizing, and I'll see you next time.